surprise appearance in a moderated conversation at a conference on Wednesday. A key question here will be how much are they going to signal that they are going to cut rates, but that is going to be the last time? Are they going to set the groundwork for cut now, pause later?
So the conversation has evolved, and clearly the data has come in stronger than they thought a couple of months ago. In August, in that Jackson Hole speech, you felt like they were setting you up for the beginning of a deep rate-cutting cycle to protect the labour market, get back to neutral, and get back to neutral quickly. That story's changed. That story's changed because of the incoming data. How much does this story need to change because of the policy changes we're now anticipating for 2025? And can he really confront that story in a big way in the coming weeks?
A lot of people are arguing, postulating that they're not going to probably address it at the meeting in a couple of weeks' time. That said, that early next year, you're going to have to start considering it. Right now, we're just getting sort of proclamations and truths from the White House South. But there is this question going forward about how that really does increase not just potential inflationary pressures, but also what we're hearing from a lot of CEOs, executives who are saying, well, maybe we're going to have to raise prices here, or maybe we're not going to be as aggressive here. So, measuring sentiment might be as important as measuring what policies actually get into effect.
Have you noticed that nobody on Wall Street wants to be bearish going into 2025? See this across the board, note after note. Looking ahead to next year. Evercore's Julian Emmanuel valuations alone do not end bull markets. Signs of a top haven't appeared. Jonathan Krinsky over at BTIG, the path of least resistance remains higher, even though lots of different things extended. Cameron Dawson, New Edge with us about an hour ago, expecting this trend to continue.
Yeah, unless the earnings don't deliver. The earnings so far have been delivering, and we're at the end of the earnings season, so we're between that. And December's tend to be a good time. How many people want to bet against a president-elect who essentially is looking to markets to ratify his upcoming presidency and to ratify some of his plans? And that is the reason why people have taken a signal from Scott Bessent, maybe too much so, and that is an argument out there, that essentially the market will act as a check on Donald Trump. Of course, as we did hear from Cameron Dawson, there's a question about whether we're creating a narrative. I know everyone's shocked. Creating a narrative around something that isn't actually moving markets. And it is fundamental data that is actually driving.
You said this last week, and I think this is really important. You brought up a note from George Saravelos over at Deutsche Bank. The market's not responding to these tariff threats. And so long as the market doesn't respond, it just leaves the door open to make even bigger threats further down the road, and even bigger threats after that.
Yeah, we're less than 4 weeks away from the election. And you have to imagine that George Saravelos is onto something maybe early next year. And that's what everyone was saying, is that maybe this is a story for 2025, less so now, when it's more a matter of signaling of priorities and signaling of threats rather than actually being in the office and wielding the ability to latch tariffs onto certain industries. And that, I think, is a reason why people aren't taking it seriously now. Why worry now when you can just play and get returns?
And keep buying stocks, apparently. Stocks, by the way, just a little bit lower this morning, down by about 0.1% on the S&P 500, following the biggest month of gains on the S&P of the year so far. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management with stocks at record highs, Ed Mills of Raymond James as Canada and Mexico respond to Trump's tariff threats, and Wendy Stewart of Bank of America on the outlook for commercial banking. We begin this hour with stocks at all-time highs, investors looking ahead to payrolls, to CPI, and the last Fed decision of the year. Seema Shah of Principal Asset Management saying come early 2025, rather than reducing policy rates at each meeting, the Fed is likely to slow its cutting pace to every other meeting, with some risk that rates don't fall as far as either the Fed or the market had originally envisioned. Seema joins us now for more. Seema, welcome back, and it's good to see you as always. How problematic do you expect that to be to equities?
Well, actually, I don't know if it's going to be that problematic for equities. I think the key thing that equities need is strong growth and almost a Fed put. So where it becomes really challenging, though, is if inflation starts to become a little bit more concerning, and then the Fed doesn't cut rates as far because they're worried about inflation expectations increasing. That, I think, would be the fly in the ointment for equities. But otherwise, I'm going to add to the masses. I'm pretty positive about next year.
Really positive about next year for the US and Europe, or just the US? Because all I've heard is the US, and Europe's kind of been left in the dust.
Yeah, I think the story for Europe has got even worse in the last couple of weeks. US exceptionalism was the story for this year. It's going to be the story for next year, even more so now that we've got the election behind us. And Europe, it was already struggling with weak fundamentals. The economy is already struggling. We've already seen evidence that now services is joined manufacturing in that cooling period. So I think it's a challenging period for Europe, and certainly for us it's more about US equities in Europe. I think there are opportunities in other parts of the world, some segments in Asia, various pockets. But overall, I think this is going to be another year where you see continued strength for the US.
Seema, can you quantify how much you're sort of doubling down on this worse than it was this year?
I think for Europe, I think the thing that we're trying to watch as well is we have to keep an eye on those technicals. Where is sentiment? We do think that sentiment is getting incredibly negative about Europe. As you just said, everyone is joining in to that very negative on that side. Valuations are looking fairly attractive for Europe. So it could be that you just need a slight improvement in the outlook for Europe, some kind of upside surprises with regards to the economy, maybe the ECB really stepping in and starting to improve investor expectations. And that could be enough to, but certainly at this stage, it's quite difficult to see that coming through.
There's a question, Seema, about whether you can bet at least on European bonds at the same time that you bet on American exceptionalism, because you can imagine the ECB is going to have to cut rates more aggressively. And if there is some sort of downturn, that could be some sort of haven trade. Do you believe that that is the correct way to go? Or do you think that that is premature at a time where the bond vigilantes seem to be having their pens and papers out for the likes of France?
Well, I think as it is always the case with Europe, you can't just look at Europe as one entity. There's so many different entities which are very different, disparate that in that region. Overall, yes, the ECB is going to be cutting rates far more aggressively than the US. I think there could be a 50 basis point cut thrown in there at some point in 2025. And they're going to be reducing rates below neutral, whereas the Fed is going to get maybe a little bit close to neutral, but probably not below. So there is reason to have that overweight to European sovereigns rather than the US. But as you said, you have to be really careful, and keeping an eye on what is going on with budget deficits in every country that we're looking at, I think is going to be a key theme for next year. Because, we talk about Fed policy uncertainty all the time, but there's so much on the government policy side. But as you said, bond vigilante is really starting to gear up and keep an eye on what's going on in different countries. We've already seen it in the UK. We've seen some idea of it within the US, and clearly is coming through in France as well. So I think that is going to be a key conversation for all the countries for next year.
Which raises the question, Seema, about whether the correct trade on American exceptionalism is with the small caps, given the fact that they seem most leveraged to the potential of bond vigilantes just peeking out the window in the United States. Even that alone would be enough to potentially dent some of the valuations.
Well, look, I think for small cap, the run it's had so far is really about valuations. It's still due for that catch-up try, so it's catching up with the large cap and it's got attractive valuations. But as you were saying before, small caps, small businesses, they have a really significant exposure to floating rate debt. So if you're not going to see very significant rate cuts coming through next year, maybe because of increased inflation concerns, then that's going to be a fly in the ointment for small caps. So I think that you can run through for a little bit longer for small caps, but once valuations start to look a little bit less attractive, and certainly from a relative standpoint where large cap does continue to look more attractive, then I think the small cap agenda starts to really become a little bit more unattractive.
New question for the office quiz over the Christmas holiday period. Do you want the new question?
Yeah, please.
What's the DAX done in 2024? I'm not going to put you on the spot and make you answer that. Seema Shah, the DAX so far this year is up by more than 18%. And as we speak about how bad Europe is, the DAX is at all-time highs. Seema, it begs the question, what is the DAX doing at record highs if things are so bad in Europe and things aren't great in China either?
It's a great question. And I think this is a key thing for investors to remember, is that, look, from a relative standpoint, yes, it's going to be big differences and these are going to look more attractive. But if the US market is doing well, it does tend to carry most markets with it. So there will be opportunities globally. And I think when we're going into 2025 with so much uncertainty from a policy perspective, especially now with the new Trump administration coming in, it does make sense to have that global diversification. Our preference is still more for Europe, but we do think that there's opportunities outside of the US as well. So you do get to have some diversification, some exposure to different markets too.
It's the banks, Bramo. Commerzbank, Deutsche Bank, year to date performed really well.
Yeah, and how much is this a catch-up trade? How much is this because there is this bet on rate cuts? And how much is it because the likes of Deutsche Bank have expanded dramatically outside of Europe? So it sort of goes to Seema's point that if they have some sort of footprint outside of Europe, they can benefit even if they're listed on the DAX.
Seema, it's good to hear from you. Seema Shah there of Principal Asset Management on the path forward into 2025. The takeaway from Seema is just how little needs to go right to really trigger some of these squeezes in some of these European assets.
Yeah, although it's a pretty high bar for a little to go right, considering that we've continued to be disappointed. I was looking, you talk about the DAX, take a look at the CAC over in Paris. And
down about 5%.
Yeah, it's underperformed the broader European stock market by the most going back to 2010. So talk about the splintering of some of the traditional behemoths in terms of economic heft of the European region. It becomes a little bit dicey to understand what the correlations are based on history because they're kind of breaking down.
France has been really, really weak. As we speak, equity futures recovering just about unchanged on the S&P. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Syrian rebel fighters are advancing southward after capturing much of Aleppo. It's the most serious challenge to President Bashar al-Assad in years amid the country's civil war, which began after an uprising in 2011. The rapid assault is being led by an Islamist rebel group based in northwestern Syria's Idlib province. Government forces, which are supported by Russia and Iran, have appeared to withdraw from some areas. Tesla and BYD are offering discounts and incentives in China to meet annual sales targets. That includes a 0% loan and cash discounts on certain models. On a post to its Weibo account, Tesla said that it's offering 5-year 0% loans and a 10,000 yuan discount on its Model Y SUV until the end of the month. BYD is on track to exceed its annual sales goal of 4 million cars, but its smaller rivals have already met their targets. And a major snowstorm blanketed parts of New York, Pennsylvania, and Michigan over the holiday weekend. Forecasters expected very cold temperatures and heavy snow to persist throughout the beginning of this week. The storm led to an emergency declaration in parts of New York and a disaster declaration in Pennsylvania, and officials warning of dangerous conditions for Thanksgiving travelers returning home. That's your brief, John.
Danny, thank you. So our holiday quiz is coming together. Name 5 companies on the Russell. Question 1. What's the DAX done year to date? Question 2. I think we need about 8 more questions.
Okay.
10 questions to make this work, right?
Yeah, I'm trying to think what they could potentially be. Which New York State county got the most snow in the past 4 days?
You know the answer to that, don't you?
Barnes County.
Okay. How deep?
It was 45 inches of snow so far.
Wow.
Yeah, if you take a look at some of the totals, it's like 4 feet that are expected in Watertown, I think, New York. So I don't think that's going to make it on the quiz. Don't worry. Stop doing research on that one.
That's incredible. Futures right now on the S&P just about recovering, almost unchanged. Up next on the program, Canada and Mexico preparing for President Trump.
I believe that he's stepping up and making this statement about tariffs to tell both Canada and Mexico, we have got to get our border security in the United States squared away.
That conversation up next.
Ways on the heartbeat of the tech
spread across global markets.
Real-time data aspect is going to be
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The path to year end looks like this. Friday, payrolls. Next week on the 11th, CPI. December 18th, the Federal Reserve, then go home. Year over. At least we hope. Equity futures on the S&P right now down by almost 0.1%. Check out the bond market. Yield starting the week just a little bit higher, up 4 basis points. The 10-year 420.91. And the surveillance this morning, Canada and Mexico preparing for President Trump.
I believe that he's stepping up and making this statement about tariffs to tell both Canada and Mexico, we have got to get our border security in the United States squared away. And then secondarily, I think he's very concerned about imports from other countries that are going to try to take advantage of the USMCA. He's also using it as a lever to get serious conversations in Ottawa and Mexico City with Washington.
So here's the latest on that front. Fresh off a visit to Mar-a-Lago, Canadian Prime Minister Justin Trudeau promising to increase border enforcement to try and avoid tariffs. Mexican President Claudia Sheinbaum also saying she's confident she can reach a deal with President Trump. Ed Mills of Raymond James joins us now for more. Ed Mills, what does that deal actually look like?
Well, I think, John, it's a question, do we pull forward some of that renegotiation of the USMCA, which is due to be renegotiated in 2026? I think it is clear that there's going to have to be significant increases in border-related items. We see that Donald Trump is going to lead off after he's inaugurated with a number of immigration-related issues. I do think as it relates to both Canada and Mexico, a lot of changes to the way in which tariffs are done on autos, and probably a huge push towards protecting the U.S. auto industry, especially vis-a-vis China. And I think what it really comes down to, especially as it relates to Mexico, is that U.S. tariff policy, John, states that you put a tariff on where a product is finished and then is able to bring things into the United States. Donald Trump is going to want to make sure that Mexico back door is fully closed.
Ed, there is a lot of people that are listening to what you say. They heard from the president in the last week, and they just believe that the tariffs that he's threatening aren't credible threats because of them. Peter Chia of Academy wrote over the weekend, consensus is right now that this is just a bargaining chip. Bring them to the table. They've come to the table and maybe get a little bit of something out from them. They don't think he's going to follow through. Do your clients see it quite the same way, Ed?
John, I think that's probably right. I was kind of going through this yesterday, thinking that when I wrote the note last week about the tweet on the 25% tariffs that could be coming, there wasn't the same market reaction that we saw back 2017 to 2021 during Trump 1.0. I think that there is a long list of tariffs that were proposed against Mexico in particular during his first term that never were followed through. So right now, I think that the market would be surprised to the extent that these go into effect. The thing that I am watching, especially as it relates to Mexico, is that I think there's a personality clash between Donald Trump and Mexican President Claudia Sheinbaum ready to happen. And I think that is probably the wild card to watch. She's going to be much more forceful in protecting Mexico, and Donald Trump is going to be also much more forceful on immigration in his second term than he was in his first term. And as that personality clash pays out, I think there's a higher probability for some of these tariffs to go into place, at least temporarily. He's talked about using some dormant authorities that the president has not been using in the past that can put on temporarily tariffs up to 15% without Congress, without an investigation on day one if he wants to do it.
And can you take that a step further in terms of what we've learned from some of the recent conversations, or at least the readouts and the contradictory readouts from Mexican head Claudia Sheinbaum and Donald Trump, as well as the recent meeting with Canadian Prime Minister Justin Trudeau? How much is this just Donald Trump testing different leaders' abilities and willingness to come kiss the ring versus actual policy prescription at this point before he even enters the White House?
No, Lisa, I think you are right. I do think that this is a testing the waters phase of this. I do think that the readouts have to be taken with a grain of salt. Donald Trump is not using kind of the traditional ways in which we deal with diplomacy, not getting the State Department involved. We all know that. So kind of each president is able to put out their own kind of message as it relates to Donald Trump or Claudia Sheinbaum. Justin Trudeau, as prime minister, is able to put out whatever he thinks that is necessary. But I don't necessarily think that this is something that you test it out, get some changes, declare victory, and move on. The issues that he's talking about, and then you put into place some of the personnel picks. Howard Lutnick at Commerce, going to be very aggressive on tariffs. Jamison Greer, who is going to be the pick for U.S. trade representative. One of the reasons Donald Trump picked him is he's going to be much more willing to be more aggressive with some of those authorities that I've discussed than Bob Lighthizer. So I understand the reluctance to over-index or over-expect that this is going to happen on day one. But tariffs are coming. It is going to be volatile, and we have to expect the unexpected when we think about Trump 2.0 for this market.
And how many of these nominees are actually going to get through at a time where we have a lot of clashes between already John Thune, who is the head of the Senate leadership for Republicans, and at least one or two of these candidates?
Yeah, so I was looking at the ones that you put up on your screen. I think most, if not all, of the picks for Treasury Secretary, U.S. Trade Representative, Howard Lutnick, more likely than not to get confirmed. FBI Director, a big question mark. The Defense Secretary, big question mark. Health and Human Services, an area at Raymond James that we've been getting a lot of more of a question mark, but probably in that toss-up category. So Donald Trump with 53 votes in the Senate, and it only takes 50 to get the nominee confirmed. Far more than would normally get confirmed if we had the old 60-vote majority that was required in the Senate get confirmed. Donald Trump will have a cabinet that he wants. There will be some exceptions, but for the most part, I've been telling clients, expect the vast majority of these nominees to be sitting in their posts sooner rather than later, Lisa.
Meanwhile, Ed, we do still have a sitting president. He occasionally tries to remind us of that. The latest coming out with some new restrictions on Chinese semiconductors, in particular having to do with AI memory and tools to build the high-end chips. How do you interpret this, basically, some of the actions that we're seeing out of the White House now at a time where a lot of people have almost discounted current President Joe Biden?
So as it relates to tech restrictions, Lisa, I've been telling clients at Raymond James, this is bipartisan. This is something that the Biden administration picked up the torch from Trump 1.0 and accelerated that during his term. We will get these restrictions out during the Biden term, but they probably go even further during the Trump term. The restrictions that we're discussing this morning are restrictions that have been in the hopper for months. The Biden administration has been working with the Netherlands and Japan trying to get a trilateral deal. There are some differences in the way in which the United States, the Dutch, and the Japanese enforce these tech restrictions. That is an unfair issue for U.S. companies. The expansion is about making sure that China doesn't engage in what has been a game of whack-a-mole, where as soon as we put on restrictions, they either move production to a new country or they establish new companies that are not on restricted lists. I am anticipating that the Biden administration tries to tighten up that game of whack-a-mole. The big question to me for clients is how much of a hammer does Donald Trump come after that next year and tries to end that game of whack-a-mole and has much more restrictive changes to semi-cap equipment going into China, especially on legacy equipment during his second term.
It's a big question for all of us going into 2025. Ed Mills of Raymond James. Ed, thank you, sir. Just check out the picture of Donald Trump, President-elect's economic team. And let's go through the names, and we'll talk about the name that's not there. Hassett at NEC, Jamison Greer, U.S. Trade Representative, Scott Bessent at Treasury, Howard Lutnick at Commerce. The market was very worried at one point about Ambassador Lighthizer going into the cabinet again, but maybe becoming Treasury Secretary, maybe ending up at NEC. I think from Axios over the weekend, almost reinforced by Ed Mills there from Raymond James, that the people that have been selected are going to be even more hawkish than Ambassador Lighthizer would have been. Axios essentially reporting that over the weekend, that Lighthizer wasn't selected because he wasn't going to go big enough on tariffs. I'm not sure what that should tell you about how far they're willing to go.
There have been a number of signs that President-elect Donald Trump isn't happy with the market, viewing some of his tariff threats as simply that and not actually having meat behind them. And it seems like that is going to be a continued theme.
a conversation, and that theme's going to be the theme potentially of 2025. On that, Wendy Stewart at Bank of America, up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Equity futures recovering here. We're just about unchanged on the S&P 500, moving into positive territory on the Nasdaq 100. The Russell, after a stellar month of gains for the month of November, the Russell up by close to 11% through last month. The small caps this morning outperforming. We're up 0.25%. With 2 hours until the cash open with some morning movers. Let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Stellantis, let's kick off there. This is the ADRs. We've done a full vote face from the management at Stellantis. They've gone from unanimous support for Carlos Tavares staying until 2026 to leaving with immediate effect. He is, as Oliver Crook in Germany said, he is the PE master of the auto industry, cutting. But did he have a big enough plan to take this company forward? We know that this is Michigan calling Turin. We have a problem. Rapid degradation of Jeep, Ram, Chrysler, and Dodge. Reckless short-term decision-making. That was back in the autumn. That was the message from Michigan to Turin. We're here too. And their sales in the United States of America have absolutely drifted down, not crashed. We've gone from the second quarter of about 11.7% market share here, all the way down, John, to just under 10%. So this is a dissipation of positioning. And what do you do to turn it around? Have a look at NVIDIA. I think there's a couple of things going on with NVIDIA this morning, down by 0.4%. More curbs from the Biden administration, but that's not going to really wrought much damage for NVIDIA. Under the hood, Bridgewater sold 1.8 million shares at the end of the third quarter. You never really know the rationale or the reasoning for these moves, but they lumped up on Supermicro. So it's just a little bit of a kicker in the NVIDIA story this morning. Gap, we spent a lot of time talking about the retailers last week. The stock is up just under 5% this morning. On earnings day, it was down 9%. Dana Telsey was sitting with you and she said innovation is the key. Well, JP Morgan sat down with the management, Richard Dickinson, and the CFO, Katrina O'Connell. And they talk about a consistency of the playbook. They have got the recipe right. It's now about execution. Jonathan, good morning.
Manus Cranny, good morning to you, sir. We'll see you again in about 60 minutes' time. I want to turn to France just quickly. Check out the euro, French 10-year, and the French equity market as well. The equity market recovering in the last few moments. The CAC 40 now positive on the session by 0.2%. As session lows, we were down by more than 1 full percentage point. Just some headlines crossing in the last few minutes, Lisa. Maybe some concessions for Marine Le Pen.
It seems as if Marine Le Pen's argument that don't take away the stuff that people really like just in the name of budget fiscal prudence has gained some traction. This saying that basically the government will not drop drug reimbursement in its 2025 budget. Basically, they were going to revoke some of the reimbursements that they give out for drug expenses. They aren't going to do that anymore. Again, this is sort of edifying this feeling that the government will not necessarily disband, that France isn't going to be in a political crisis in the near term as a result of basically kowtowing to some of the demands coming from the far right.
Supporting French assets just for now. We'll keep an eye on that story for you. Under surveillance this morning, a top story over the weekend. Stellantis CEO Carlos Tavares stepping down following a board dispute over weakening sales and a stock slump. Sources telling us here at Bloomberg a new CEO will be named in the first half of 2025. Ollie Crook did a great job of covering this story out of Berlin for us a little bit earlier on this morning. Clearly, the path forward is a troubled one. And right now, there's no one steering the ship.
Real question of what they plan to do to turn things around. Will it be a fire sale of inventories? Had some cold water poured on that from Tom Narayanan. They don't really want to do that if they can help it. There's a real question about a spin-off of potential brands or closure of others. It seems like universally, whether it's dealerships, whether it's actually the workers on the line, everyone seems happy that there's some sort of change based on the commentary. So question now is, how do they turn the ship around at a time that's very difficult for the auto industry?
We spoke to Carlos a number of weeks ago. He was always generous with his time. He really laid out the challenge for European automakers into year end. He wanted ultimately to see a plan from European officials to incentivize the purchase of some of these EVs, which were lagging across the continent, or ultimately we'd have to cut capacity. That's not going to win you any friends with the workforce. Didn't win many friends with the dealerships. We saw those complaints because there weren't enough investment, wasn't enough investment. Their complaints were things like there weren't enough models to sell, new models. They were the problems there. I want to understand where the tension was between John Alcon, the chairman of the company, heir apparent to the Agnelli family over the last few years. The tension between him and Carlos Tavares. What did Carlos want to do that Alcon was upset with?
Did he want to spin something off or close a specific brand? We will be looking for the write-up, the play-by-play about what actually happened over the weekend. In the meantime, a real question of why Carlos Tavares wasn't the fall guy, why he didn't make all of the hard, bad decisions and then leave. I mean, ultimately, there was sort of a question, don't you want a clean house? And if you're already unpopular, well, it's carte blanche to go do all of the unpopular things that people are saying might be necessary to revive the brand.
Still waiting for that kitchen sick moment for the European automakers. Canada says it will step up border enforcement in a, quote, visible and muscular way as it looks to avoid tariffs under a new Trump administration. The Prime Minister Justin Trudeau met with President-elect Donald Trump at Mar-a-Lago on Friday.
What do you think that conversation was like? We're not the problem. Why are you picking on us?
They looked happy around the table.
Yeah.
I've got no idea what the conversation was like behind closed doors. I imagine it was slightly different.
You know, play along, just make me look good. I'll have a win here. Look, ultimately, Canada needs the U.S. just as much as the U.S. needs Canada. And nobody seems to be taking, as you've pointed out many times, some of the threats for tariffs seriously, particularly with Canada and Mexico. If there truly were some sort of massive 25% tariffs, but particularly with Mexico, that would torpedo the entire auto manufacturing industry in the United States. So let's see what actually happens. And it's the reason why people aren't really taking it seriously.
I want to be very clear about what we're saying here. They aren't taking it seriously. We're not making a judgment about whether they should, because that's a very different conversation going into 2025. Maybe they should be taken it seriously.
Especially if the Axios reporting is correct, that Robert Lighthizer wasn't selected not because he would be too extreme on tariffs, but because he wouldn't go far enough. And that's a real question here. How much is this going to be raising the ante, especially if the market doesn't take this more seriously?
The Biden administration is making its own moves, restricting exports to 140 Chinese companies in the latest effort to rattle China's chip industry. Reuters reporting restrictions will also be placed on Huawei's chip-making partner, Semiconductor Manufacturing International. That's another issue this sector's going to have to deal with into 2025. Big issue for commercial banking as well. Wendy Stewart of Bank of America saying next year will be a year of change and uncertainty. Certain sectors and industries will benefit, others may not. I'm pleased to say that Wendy joins us now for more. Wendy, welcome to the program. I'm just thinking of the long list of things that your clients have to confront in the next 12 months. Taxes, tariffs, the prospect of interest rates not coming down as fast as maybe we thought they would only 2 months ago. What's the number one issue in the conversations you have at the moment, Wendy?
Good morning, Jonathan, and thank you for having me. So, when you think about our clients in global commercial banking at Bank of America, we work with over 15,000 middle market companies that are based in the U.S. and Canada, and they also do business around the world, and we cover their international subsidiaries. And these clients are publicly traded companies. They're also privately held companies, and we're continuing to see the generation transfer from the second to the third and the third to the fourth gen. And so, when you think about all of the things that they're faced, there is a lot of uncertainty as we go into 2025. And you mentioned a lot of the things that are top of mind for them: increasing considerations around tariffs, taxes, interest rates, inflation, and then also just the geopolitical tensions that we've seen. And, let me give you an example. We have a lot of clients over the last 18 to 24 months that have looked at what is happening geopolitically. They do a lot of business in Asia, and as they've looked at their China Plus One strategy, they have moved some of that business into Asia. And they've also moved that into other parts of North America, specifically into Mexico. And you all have been talking a lot about tariffs and what will that mean for clients. And we've got a lot of question around that still. But I can tell you one of the things they're focused on in Mexico right now is the deflationary environment with the peso. And so we've been working with our clients to help them with that. And I do think that while we see a lot of uncertainty, we are looking at how we turn that into opportunity.
Well, Wendy, let's talk about that a little bit more. Are they in a position to play offense, or are you finding them holding back on making big investment decisions, big capex decisions until they've got the clarity on policy into next year?
I would say they're not making big investments, but they are making targeted investments. And so, we have seen a lot of good opportunity for our clients, especially, when you think about investment banking. And these aren't necessarily some of the M&A that would hit, the headlines very broadly, but clients are looking at opportunity to make those targeted investments. And I'll give you an example. We have a client that's based in the southeastern United States, privately held company, and this company did not have an exit strategy. They wanted to take some liquidity off the table, and they were looking at that liquidity event. And so in the meantime, we had another client that is based in Europe. That company did not have any U.S. exposure. And so these two companies, we introduced them, and it was a great fit. It enabled the Southeastern company to have that liquidity event they were looking for while also retaining a minority stake in the company. It then allowed the European-based company to have that U.S. exposure that they wanted, and we were able to leverage our international expertise to help with that specific transaction.
Wendy, this really raises a fascinating question, which is how much are you seeing a rush of foreign companies looking to partner with a U.S. company to get ahead of any potential tariffs or any potential actions from President-elect Donald Trump?
We are seeing that. And, I don't know that I would call it a rush. I think we've had ongoing interest all year as companies around the world are looking at how they can diversify into the United States. The middle market client base that we cover is very attractive to them. And we are in a great position to help make those introductions and to see, where those fits would make a lot of sense. And we will continue to do that.
Is there a level at which borrowing costs become prohibitive for some of these companies to expand in the U.S., especially if they're smaller? And we're asking this question as small caps outperform at a time that yields are historically relatively high, at least based in the past 10 years. Is that a concern, or is that not even on the table?
It's not on the table. When we were looking at the interest rate environment in the U.S., we were expecting that to continue to come down later this year and into next year. And for companies that are outside of the U.S. and might look at exposure into the U.S., there is the ability to manage that interest rate exposure globally, and they can certainly take advantage of borrowing in different currencies depending on what their needs are.
Do you get the sense, Wendy, going forward, that there has been certainty for some of these smaller companies in different regions to expand, to hire, to make some of the decisions that we heard were stymied by some of the political uncertainty prior to the election?
Absolutely. I mean, when we look at our clients, I would say the sentiment's interesting right now. There is a lot of optimism, and I think there is some pent-up demand. Clients, I think, have been a bit surprised that the economic environment has been more stable than they were expecting. That combined with interest rates coming down and that demand is creating opportunity. And we continue to work with our clients not only as they focus on the geopolitical tensions, what that means for them internationally, but also here domestically. And we are continuing to do a lot with clients with the core banking needs that they have, whether it's loans, deposits, really helping them to manage their the cash management process. And we have a new client that we've started working with that's based in the Midwestern United States, and this company is also doing business in Canada. They have exposure in two geographies outside of North America in two different regions. And when they looked at that entire cash management ecosystem that they had to manage, they were doing it on a very manual basis. They didn't have a lot of visibility. They had FX risk that they wanted to take off the table. And so we helped them with our Cash Pro system to put a solution in place. It is the platform into the bank that is both online and mobile, and it's enabled them to really manage all of this exposure and continuing to grow in a way that is safe, secure, and very efficient.
Wendy, you've given us some really specific examples, and I was just noting down some of the themes: managing the supply chain in Asia, managing the FX exposure, particularly down in Mexico, getting a presence to the United States, working that out too. Wendy, what I hear here is the need to be with a bigger player, and that's what we saw coming out of the regional banking crisis as well. Customers were looking to the Bank of Americas of this world. Wendy, is that still the same now? Have you held on to those clients? Are you seeing more clients come towards you ahead of 25?
We are. And in fact, 2024 has been a great year for us. It's our second strongest year in terms of client acquisition on record. And we expect that to continue into 2025. And it's for all the reasons you've just cited. Our client base is more global now than ever, and they absolutely need a partner who can help them navigate a lot of this uncertainty and turn that into opportunity for them to help them grow.
Wendy, this was brilliant. A belated happy Thanksgiving to you and to your family too. Thanks for being with us. Wendy Stewart there of Bank of America. Really specific. I think really offered a really good look at what's happening now with corporate America. And I would say arguably corporate America and beyond for the whole world over three big issues: supply chains, FX exposure, and you need a presence in America right now. Selling into the United States is not enough. You need to be in the United States.
Which is a reason why those sort of cross-border investments are going so strong. You raised the question, how much does this really advantage some of the larger players to the disadvantage of some of the regionals that haven't yet clawed back? Do they have a permanent structural disadvantage because of some of these types of trends?
Imagine being exposed to the peso after the month we've just had. Some of those moves are vicious.
Problematic, yeah.
Oh, huge problems potentially. That's the latest story on the banking front. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President-elect Trump is bringing someone that he pardoned into his administration. He's nominated Charles Kushner as U.S. ambassador to France, praising him as a tremendous business leader, philanthropist, and deal maker. Kushner is the father of Jared Kushner, Trump's son-in-law and former senior advisor. He served 2 years in prison for filing false tax returns, witness retaliation, and making false statements to the FTC. Volkswagen workers in Germany have begun their temporary walkout, hoping to pressure management during deadlocked negotiations over cost-cutting measures. The union opposes management's plan to close 3 German factories and lay off thousands of workers. A fourth round of negotiations is to take place 1 week from today on December 9th. And it is Cyber Monday, and consumers are looking for deals online. Adobe Analytics, which tracks online shopping, expects consumers to spend a record $13.2 billion today. That's 6.1% more than last year. That would make it the season's and the year's biggest shopping day for e-commerce. That's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, Bod Vigilantes thriving in Europe.
The French government doesn't take ultimatums. It's looking at the French parliamentary debate. It's respecting each and every parliamentary debate that leads to an evolution. We will take into account what is changing, but we won't be blackmailed. We are committed to reduce the deficits.
We'll get you the latest on a last-minute concession to Marine Le Pen in just a moment from New York. This is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
Go.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Stocks are doing okay here, coming off a month of gains that's delivered gains of more than 5% on the S&P and on the Nasdaq. We're just about unchanged on the S&P, so no drama here. Bond yields a little bit higher, off session highs. We're up 3 basis points on a 10-year, 419.75. Under surveillance this morning, bond vigilantes thriving in Europe.
The French government doesn't take ultimatums. It's looking at the French parliamentary debate. It's respecting each and every parliamentary debate that leads to an evolution. We will take into account what is changing, but we won't be blackmailed. We are committed to reduce the deficits. The government is a government of dialogue, of respect, of co-construction. This budget has been co-construction. It's not the result of just a government project.
So here's the latest. The French government offering a final out concession to Marine Le Pen's party on the 2025 budget, seeking to avoid being ousted from power in a no-confidence vote. The political uncertainty recently sending French borrowing costs to the highest levels relative to Germany since the Eurozone debt crisis. Joining us now to discuss is Michael Kushner of Morgan Stanley. Michael, good morning to you.
Morning.
Giant step back. Lisa's talked about this for a while. I think she's right to pick up on it. Bond vigilantes are back and they're thriving in Europe. We saw it in the UK. We're starting to see it in France as well. Maybe Prime Minister Barnier can hold on. I've got no idea. But to Lisa's point, they're not going to be blackmailed, Lisa, but it sounds like they just were.
100%. Essentially, we're not going to be blackmailed. Yet here you have it, and our deficit's going to be a little bit bigger for a while.
What do you think is behind this more assertive bond market, particularly in Europe?
I think it's the fracturing of political consensus to what to do with the challenges that are being faced, and putting a burden on fiscal policy when many countries have very little fiscal space to actually deal with this, with increased spending, cutting taxes, things like that. So how do you deal when you're getting pressure from all sorts of directions, and one policy mix will fix the problems you're facing?
As an investor, how much does that make you stay away from places like the French bond market, simply because if they do cut their budget, their economy tanks and they have no government? If they don't cut their budget, they have an increasing deficit and with no signs of fixing it. How much do you just stay clear?
I think that's exactly what you do. So I think we've been recommending and following an underweight position relative to French government bonds, relative to other countries in Europe. They're being helped by the fact that German bond yields keep going down. So though the spread's widening, absolute borrowing costs are not rising that rapidly. So they haven't risen to the levels we saw in the sovereign crisis back in early part of last decade, because German bond yields weren't just rising everywhere and causing punitive borrowing costs. Borrowing costs are not really a constraint on French borrowing at the moment, but they could be over time. How is it resolved? Usually it gets worse before it gets better, and forcing actions which are painful to somebody, but actually resolves the problem going forward. Think about today that Greek 10-year bond yields are lower than France, when Greece was completely insolvent 10 years ago.
So this raises a question is there a certain profile of countries that are susceptible to bond vigilantes versus not? I think about the likes of France, yes, maybe Greece, although not anymore because evidently they trump France. But in the U.S., it seems like the U.S. is immune to the potential for bond vigilantes, even though the debt to GDP looks like it's on a trajectory that's far worse than any of these countries.
I think it's a couple of things for the U.S. One is the exceptional performance of the U.S. economy and the exceptional position of the U.S. dollar in the sense of a global reserve currency. And President-elect Trump has talked about that important aspect of having the exceptionally strong currency around the world and use of it around the world, which gives the U.S. a special sort of situation. It would borrow its own currency, and everyone accepts the dollar for global payments. Over time, however, things can get out of control. We saw that in the UK with Liz Truss's government for a little while. That's farther down the road, and the issues in the U.S. aren't insoluble. They just need to be dealt with, and they can be dealt sooner the better, because modest changes can affect the trajectory meaningfully over the next 10-15 years. So it's more about, I think, the next couple of years. Where is the new administration going to be with regard to containing the growth of the deficit and debt overall? If it's not contained, if it continues to grow bigger, at some point in the next several years, I think there will be a constraint on government policy, which usually creates an adjustment.
Michael, we should perhaps acknowledge there is something somewhat unique about this moment. These issues are arising in Europe outside of recessionary conditions. We saw that in the UK, we're seeing it in France. We're running budget deficits north of 5% in America, with GDP running at very robust levels and unemployment close to 4%. My question really is how these bond markets will behave in economic downturns. In developed markets, they are bought. When things go wrong, you buy those bonds. Are we going to challenge that next time around?
It could be, and how we fixed it last time with quantitative easing, right? When to make sure that monetary policy or deficit problem, inflation problems did not cause problems for long-term interest rates, the central bank stepped in and bought trillions of dollars of government bonds to support the monetary and fiscal policies being used. But down the road, if central banks feel constrained and don't want to do that, then it becomes more problematic.
Does this become problematic for portfolio construction?
It does. Well, inflation has been actually going up a bit in the United States lately, in the last couple of months, or core PCE data, which is what the Fed's preferred measure of inflation. That's been going a little bit the wrong way. The unemployment rate has been coming down a little bit the last couple of months from the levels we saw in September, putting a little more pressure on the Fed. Maybe we shouldn't be easing too aggressively going forward, given the situation, which again puts upward pressure on bond yields.
This has got to be the number one question going into a potential economic downturn. Let's assume we get one. Do bonds behave as a ballast in the portfolio next time around?
It depends on what causes the downturn and whether it's stagflationary. But ultimately, it's a great question, because if you do not get that kind of haven reinforcement, of bonds that really limits and ties the hand in terms of the fiscal response to any potential downturn. And that is the fear that people have, including the Federal Reserve. Maybe the reason why they are acting a little bit more carefully right now as they try to thread this needle.
Michael, good to see you. Great to catch up. Michael Cushman there of Morgan Stanley. Next up on the program, Tom Kennedy of JP Morgan, Dana Telsey of the Telsey Advisory Group, Claudia Saab of New Century Advisors. As we look ahead to Payrolls Friday, we'll also catch up with Tom Titsouris of Strategas. The third hour of Bloomberg Surveillance is just around the corner.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it, on Bloomberg Technology.
We are very focused on playing one game and one game only, and that is being free, frictionless entertainment for consumers. But what I will say is we are doubling down on the strategy. We believe it's working. We think the tailwind's in our favor, and it's on us to continue to deliver.
Whenever you're doing something innovative that hasn't been done before, there's a lot of trial and error and iteration. It just always has these zigs and zags along the way, and I think where we've been successful is really being reactive.
Hollywood is the history of technology. Like, we are here because of a technological breakthrough, right? And so we sometimes forget that art and technology kind of like come together always. And for us, it's like demystifying a little bit the technology. Again, if you understand AI as a tool for humans, then it changes the narrative. And it's less about fearing it and more about embracing it.
Don't miss Bloomberg Technology, live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg. I'm David Gura in Rio de Janeiro.
At the end of the day, the best fundamentals are still in U.S. large caps.
Everybody's on the same side of the boat, which makes the market vulnerable to volatility.
Everything seems to be going the way you want
it to go. But I think there are significant amount of uncertainties.
You're going to get some good results. You're going to get some bad results. And that's going to kind of create volatility in the market.
Once we get a little dose of reality into 2025, I think that's when you want to start to take some risk off.
This is Bloomberg Surveillance with Jonathan Perro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now with equity futures recovering. We're just about unchanged on the S&P 500. On the Nasdaq, just about in positive territory. And on the Russell, after a rip-roaring rally through the month of November, we add some weight to that as we kick off December trading, up by almost 0.2%. Going into payrolls Friday, the estimate in our survey, 200K. The high is 270 over at Morgan Stanley. The low is 155 over at Citi. That's Andrew Hollenhorst, trying to bounce back from the previous number, which was a terrible 12K.
And we do get jolts tomorrow ahead of that, though that will be muddied by the weather disruptions. You raised the question, John. How high is the bar for the Fed not to cut rates later this month? And how much do we have to see a really rip-roaring number and also an unemployment rate that falls back down and also wages that pick back up in order for them to do that? I think with that light, it is fascinating that Jay Powell suddenly signed up to do a Q&A on Wednesday at a conference, because it raises the question, what do they want to be messaging at a time that does seem pretty fraught with accelerating growth at the same time that they seem to be on a somewhat preset rate cutting path?
We don't assume, we don't speculate. You remember the lines coming out of the news conference?
Yes.
How much speculation will they be doing this month, looking out to next year and beyond?
How much do they try to remove the political tinge to this by just saying that the economy has been performing better than we expected? That, to me, might be more interesting as a way to subtly communicate that they are having a shift in sentiment on the Federal Reserve Board.
So there's a two-part story before we get to the big one on December 18th. Payrolls this Friday, CPI next week. BMO's Ian Lincoln reckons you need a strong report on Friday and a robust CPI number, signaling maybe some sticky inflation to get this Fed to pause on the 18th.
Otherwise, why not just cut rates and signal that they're never going to cut rates again? Because there's essentially a lot of people are getting on board with that, and it leaves them open to a lot of political leeway, because you have to imagine that 2025 will be all about Jay Powell defending the independence of the Federal Reserve at a time where he already has staked out his territory with a very definitive, I will not go.
We might have a shadow Fed chair, mightn't we? Kevin Walsh, who knows?
Let's see how this goes. But all I know is that he was very definitive when asked about it. And that was a response of a lawyer who had prepared his brief.
Agreed.
And is prepared.
That was the standout moment from the news conference about a month ago. Coming up this program, we'll catch up with Tom Kennedy of JP Morgan as the S&P 500 caps its best month so far this year. We'll speak to Dana Towsey of the Towsey Advisory Group on a record-breaking Black Friday, and Claudia Sahm of New Century Advisors looking ahead to November payrolls. We begin this hour with equity futures just about unchanged, following the best month of the year on the S&P 500. Tom Kennedy of JP Morgan looking ahead to the last Fed meeting of 2024 and writing odds of a pause have grown meaningfully. The labor report on Friday really matters, particularly the wage data. We view risk to the soft landing as balance between recession and inflation reaccelerating. Tom joins us now for more. Tom, good morning.
Good morning.
Two very, very different risks for 2025. What are you telling clients they should do?
I think it's just balancing out their portfolio to make sure you feel comfortable with your strategic asset allocation. Are you aligned there? Do you have big overweights? Are there places we can correct? I think heading into this meeting in December, it's really fun to just play this game that you guys are going through here. First thing they're going to look at, what's the probability the market assigns to a rate cut? 65% as we sit here today, so they're getting good optionality. But the really important thing they're going to do is check in on their SEP from September. Growth number for 2024, 2%, it's too low. Inflation number, 2.6% core PCE, that's too low. And the unemployment rate, they have 4.4 in for 2024. That's probably too high, which is why we come back to this report on Friday, why it really matters. Well, I agree with you guys. Last month for payrolls was an anomaly. We got to make sure we're still on a really good track here, and then the Fed will have optionality. That's really what I expect out of Powell this week. He's going to try to just confirm that he has optionality. That's what data dependence is.
Well, based on what you've just said, I'm not sure what the options are. Because if you go into this meeting and you revise growth higher, revise inflation higher, and revise down unemployment, how on earth are you cutting interest rates?
Yeah, I think it's going to be now about where is this neutral rate estimate that you have. Lori Logan, who's the president of the Dallas Fed, gave a great speech last week. Could have been the week before. Just about the range of
the player, Tom. Don't worry.
The range of outcomes on neutral in the range of estimates. And we are getting to the top end of that range. Now, I think what Lori was trying to do is to say that we are data dependent. We're going to have to feel our way out here, but we're getting to the top end of the range. And the market really has responded by pricing in more pauses into next year. I think that's the real question that they'll have to come out with. If they do end up cutting, it's just going to be about rates are just restrictive still here, and we can cut and still get that soft landing.
You mentioned the game that we were playing and that we have fun doing it. There's a question about whether it matters even right now, given the fact that it seems like the Fed has kind of taken a back seat to just the actual raw economic data and the headline policy making that seems to be happening. So do you think that it matters? Do you think that ultimately, whether they cut or they don't cut, it's going to make a big difference for a lot of investors?
The way I really think about the does it matter or not is, if the reason they're pausing is that the economy continues to surprise us for the upside, which going back to my notes with you guys for the last 2 years, that's been a theme consistently. The U.S. economy is surprising to the upside. If that's the reason they're not cutting, what's the type of equities that I really want to own? And if the event that they're cutting because the world is slowing, do I have the right types of ballast in my portfolio to keep my portfolio as resilient as it can be going into 2025? For our outlook, resiliency is a big piece of this, because when I look at client portfolios, they tend to be still overweight risk and overweight cash, not a very resilient portfolio.
You talk about the two bifurcated risks, one of recession and one of a reacceleration in inflation and growth. Do you have one scenario that seems more likely than the other? And if the Fed were to cut rates in a couple weeks, as most people expect, is that risk of a reacceleration that much greater?
I think the point of saying that they're balanced between these risks is that it's a more normalized environment than what we're willing to appreciate. For the last 15 years, we have had the comfort and resiliency of the Fed forward guidance. And at the moment, we just don't have any forward guidance. So in your portfolio, those balance of risks being relatively equal is to really signal from our perspective to the world that is your portfolio really balanced for the risks in the outlook looking forward. Go ahead.
Well, what is the ballast for a recession?
I still think it's going to be the Treasury market and core bonds. Talking about this in the prior segment.
Yeah.
The real point of it is, where would you go when the economy and revenues for your stock that you own, those revenues are deteriorating? Where are you going to go to hide? What are your real options? I don't really think there is anything else besides the Treasury market at the moment. Is it cash? Or really what we're trying to push our clients into is thinking about alternative ways to find income that are long duration. In our family office survey from this year, 45% of the wealthiest families in the world own alternative assets. Historically, we would say, oh, you can't own alternatives because they're illiquid. Well, 50% of all of our private asset alternative raises this year were in evergreen products. The market is changing. The ability to financialize alternatives allows people to own real estate, infrastructure, different assets for income that don't need to necessarily be tied just to the Treasury market.
Completely depends on what the objectives are, but certainly if you're retiring, you don't need the money for 20 years. You've got to ask yourself why you need the daily liquidity. This is an argument that Apollo has made repeatedly over the last few years. Do you see clients changing their attitudes to alternatives?
Absolutely. I think if you look out 3 years from now, every single one of our clients will have more alternative assets in their portfolio as a percentage than they do today. This financialization helps them, but also in the private space, things are evolving as well. The secondary market is growing. Get more liquidity in your existing private equity alternatives. And then also private credit. How many years now? Private credit's a bubble. It's a key piece of the financialization, and it's adding liquidity to sponsors at a time when they need it, and investors are willing to take the higher return.
Who loses out? And when I say who, I'm thinking about what asset class, what securities would typically attract that money, but won't anymore.
I think it's mostly going to be about how do banks adjust themselves to be a part of the lending solution here. There's concentration happening in the banking sector as well. I don't think it really does crowd out things, John, in the way that you're talking about it, saying money has to come from the public space to go to the private. IPO issuance is non-existent. When are we really going to ask the question of why are we expecting IPO issuance to go back to what it was? I don't think we should. The private business owners don't need to go public anymore. There still needs to be a certain amount of that just for the sponsors and the private equity back, but we don't really think IPO issuance is going to go back to where it was. So just the nature of new assets and new money is going to flow there.
This raises a question, and I just think of Adina Freeman over at the exchange, screaming, throwing things at the screen as she listens to you. And there's been this argument that actually, if you don't have companies going public and putting the disclosures and having the same kind of transparency, that somehow impedes the integrity of the system. Are you saying that risk has not materialized and won't materialize in a lot of markets that people traditionally have thought of as more obscured?
I think you're going to need to see transparency come to that market. We're already seeing transparency. JP Morgan provides most of the leverage to the private credit space. What does that mean? A sponsor who's giving the loans out takes leverage from a bank. So they're still connected to the banking sector. And that affords transparency for us to see those individual loans. I just think the nature of transparency will change, Lisa.
Is the argument that essentially traditional asset classes, bonds, stocks, aren't going to have the same kind of returns going forward because we brought forward a lot of those returns and because yields are higher?
Not necessarily. I mean, you look back in history when you see big years like the one we just had. Over the last 75 years, if you see a 20% gain in the S&P 500, on average that next year, you're up 10%. And about 80% of the time, you're up the year after. So markets can do well. I'm just saying the nature of where the earnings for these businesses is happening is shifting from public companies to private companies. And this, my clients need to adjust alongside it and invest alongside those earnings. And that nature, I think what I'm trying to draw out here is, when are we going to ask? This is a constant, perpetual change. Reversion to the mean in this sense is unlikely to happen.
You touched on it. Key overweight, big favorite for next year, financials, the banks. And part of it is the IPO story, all of this activity picking up again. Are you questioning that allocation going into next year?
No, I think
you still like the financials.
I think financials look fantastic from a perspective of earnings growth changes happening. That's alongside the soft landing, and you can actually see leverage start to accumulate. It doesn't have to be the IPO market. It can be leverage accumulation or leverage extension elsewhere. Also, the curve should start to normalize here, again, incentivizing the lending market to pick back up again. And from a valuation perspective, it looks relatively attractive to other things we have. So financials is a key overweight for us, and then also industrials and utilities. Tech as well, but we're broadening out that tech discussion. It's happening the last 3 months for sure, arguably somewhere in the 6-month range. You're seeing the broadening out. That's where we expect earnings to accelerate the most in those three or four sectors.
Utilities have been part of that tech discussion for most of this year. Tom, it's good to see you. Appreciate it. The conversation I didn't expect to have about capital allocation and some of these big shifts we're seeing.
But it's actually really relevant at a time where there's been so much money flowing into the United States and U.S. exceptionalism, and people say valuations are high, especially if a lot of these public companies comprise a much smaller portion of the overall investing market than they have traditionally. So it's one that we have to keep going back to, even though it's not exactly in tandem with some of the more visible balls and strikes.
Mark Rowan's been saying it repeatedly to us on this program now for the last few years. Equity futures right now in the S&P just about unchanged. Let's give you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The French government is seeking to avoid being ousted from power in a no-confidence vote. Prime Minister Michel Barnier offered a final hour concession to Marine Le Pen's party on the 2025 budget. His office says that he has committed to not cutting reimbursement for medicines. France's parliament is due to convene at 3 p.m. Paris time. People familiar say De Beers has cut diamond prices by more than 10% across the board. The Anglo-American unit has tried and failed to put a floor under the slumping diamond market. Man-made diamonds and a collapse in China's luxury market have both undermined prices. The price cut is its first since the start of the year and a historically large reduction. The Buffalo Bills are headed to the playoffs after last night's 35-10 win over the San Francisco 49ers. The freezing temperatures and continuous snowfall couldn't stop Bills quarterback Josh Allen with 4 touchdowns, including 1 rushing and 1 receiving. The defending NFC champion 49ers season continued to go downhill last night, with Pro Bowl running back Christian McCaffrey injuring his knee on a non-contact play. Week 13 continues tonight with the Browns and the Broncos on Monday Night Football. That's your brief, John.
Danny, thank you. Those fans dedicated. Did you see the conditions?
Oh, yeah, there was like snowball fighting.
Ridiculous.
Well,
they're like wading through snow to find their seats in the stadium.
It just adds to the extremity.
How doesn't that game get cancelled?
Of course not. It's like ice fishing, except watching football. It's honestly, it's wonderful.
That's
It's extreme.
enjoyable.
Well, you then play in the snow. You feel like you're hardcore. You go home. You have war stories to tell your children. I absolutely endorse it.
You get ill. You don't go to work.
Oh, come on. Have some fun.
Okay, apparently that's fun. Up next, the Morning Calls Plus, Dana Towsey of Towsey Advisory Group, as retailers see record online Black Friday sales. That conversation is up next. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The opening bout 1 hour and 13 minutes away. Equities are doing okay, just turning positive in the last few seconds. Yields are still higher by 3 basis points. The 10-year 420.32, and the dollar stronger against everything in G10. The euro down to 105.11. Time now for some morning calls. First up, Stifel raising its price target on Tesla to a street high, noting confidence in its FSD capabilities and Cybercab promise. Your second call from Guggenheim, downgrading Coles to neutral, citing softer sales and a CEO transition. That stock is up by about 0.4%. And finally, JP Morgan upgrading Gap to overweight, saying the company is at an inflection point to support sales growth. That stock up again by 4.8%. Let's stick with retail. Retailers seeing a record-breaking Black Friday. Data from Adobe Analytics showing consumers spent $10.8 billion online as they look for the best possible deals. Dana Tausi of the Tausi Advisory Group writing, the theme of holiday 2024 is one of selectivity, whereby both consumers and retailers are more discerning in allocating dollars. Dana joins us now for more. Dana, good morning.
Good morning.
Busy few days for you. You've been into the store so we don't have to. What's it like?
I think overall, traffic built as you went on through the day on Friday. You don't have the morning rush like you did in the past because the promotions are elongated and you could have gotten the deals even earlier on. But the going rate seems to be 30% off. You could get additions to that as you go through the weekend. And today's Cyber Monday expectation is for 6% increase in online sales on Cyber Monday.
Is it a legit 30% off? Because there is a take at the moment for consumers. I think they've started to believe that maybe these deals aren't really deals and that maybe they're being misled somewhat. Are they real deals?
They're real deals. They're real 30% off. Look at the inventory levels. They're not piled high to the sky like they had been in the past, but you're getting the deals for the event-driven spending that's out there. And retailers know they have to promote to do that. Look at the traffic we saw. We had teams around the country, and basically whether it was Abercrombie & Fitch, Victoria's Secret, Bath & Body Works, Ulta, Sephora, Lululemon, we saw lines. Now, is it all day? It's in the height of the day when you saw that traffic.
Never changed, John. Are they really deals? How are they just trying to
what they
mess
do.
us over? I
They
do.
say it's 30%,
Yes.
but it's 30% off a price they charged for about 5 minutes a year ago.
Right. Well, this is the reason why people are more selective and discerning with their money and then put things in a basket and wait for an additional 10% off. So if you want to do that, the Farrow household is open to you. I am wondering if there are certain types of stores that saw traffic as people became more discerning about the experience, too, that they wanted to be having. I think you saw the specialty stores, probably Victoria's Secret with the lines that they had. That was compelling. You haven't seen those lines in years past. Bath & Body Works always has a line on Black Friday because of the deals that they do give. And then what you saw at Hollister's level of promotions was 30 off. Last year it was 40 off. We have a tracker that goes back to 2018 showing the differences in the level of promotions. And for the most part, Nike was the one that was a little bit more promotional than it was in the past, which is not totally surprising. Do retailers like that e-commerce is taking such a big slice of the pie? And I don't mean this in terms of other people's, but I mean even their own. Is it less profitable for them to sell online with all of the returns and the processing and the expectations that come around that? Overall, you need both. And what you're seeing today is a lot of the stores fulfill a lot of those online orders or the buy online, pick up in store. Overall, online sales are still an important part, but still physical in-store shopping is the greatest part. You're not seeing the big pickups in traffic because people have been shopping all along.
but physical retail and the newness of stores that are out there. Look at the new Aritzia store that opened in Soho. The traffic was big there on Thanksgiving Day when I was there, and even on the Friday on Black Friday too.
To John's point about, is this really a deal? How much have these stores cannibalized from the excitement around the post-Thanksgiving shopping moment, given the fact that these deals stretch over a longer period of time and feel like an evergreen type of event?
So overall, retailers buy for events. Retailers will buy for promotional time periods. We always know that traditionally after Thanksgiving weekend, you go into a lull until the 10 days before Christmas when a lot of the shopping is done. But you look at this year with 5 fewer days than what you had last year, Black Friday weekend could account for nearly 20% of the holiday season sales for the week of the whole Black Friday week. Because now you have fewer days in order to when we get to December 25th.
Dana, who's winning?
I think overall you have Abercrombie's winning, Hollister's winning. Frankly, Victoria's Secret did well. I think Old Navy is taking share. As the weather got colder, people started to buy. Walmart's winning. You look at value, look at the traffic in TJX and TJ Maxx, which has become more gift oriented.
I'm not going to ask you what the correlation is between temperature and Victoria's Secret, but you've mentioned the company a couple of times. I'm not sure it's the winter weather that's doing that. What if they changed? Why is that company making a comeback?
I think some of the stores are retrofitted. I think some of the product lines are retrofitted. They reintroduced sport. They reintroduced bathing suits. They still have a long way to go. But notice lines there, which was different than we saw last year.
I think that there are a lot of theories out there about why that store has come back.
Yes.
And I think that we can explore them at another time. I do want to just take a bigger question. Of course, you're like, why not explore them right now?
No, I'm genuinely curious now. Now you've mentioned it, you seem to know something I don't.
Yeah, well, they changed the look, right? So it had been going for a very progressive kind of everyone's body is wonderful kind of look. And then they reverted back to, the Victoria's Secret.
Oh, Hot's made a comeback. We're doing this in real time.
Please.
Is that what it is?
Can you explain, Dana?
Basically, you have the new leader who came in. She's going to basically retrofit the brand. She's Hillary Super, knows how to merchandise. Let's watch the next year and see how it progresses.
What has she changed so far?
She just started September 9th. So it's first to come.
So what do you think is bringing the crowd back?
So the categories that are coming back, like the sport category that wasn't there last year at this time.
Oh, so they're challenging who now? They're going after Lulu?
No one's going after Lulu. Lulu's on its own because, frankly, what we saw this weekend, Lulu had the most traffic. If you look in that segment, Aloe second, followed by Vuori third.
Let's talk about Vuori, some of the private market challengers. How much of a challenge are they providing to Lulu?
I think overall, when a category gets so popular and the margins are so strong, people come in. But when you look at what makes a leader is driven by the technology innovations that they have. Lulu's going to report their earnings later this week, and it'll be interesting to hear about the newness they're putting in, both in terms of their core men's product and women's product. And don't forget the growth in international.
Vuori versus Lulu. Bramo, you know that story well.
Well, I like Vuori, but I have Lululemon products as well. I just noticed that Lulu actually ended up not having the same quality that they previously did. There was a quality shift, but that seems to have revived. And I will just say, Lululemon does report earnings this week, I believe. So we will get an update on that.
For that. And if you go into store and wait long enough, someone will come in and clear off the shelf and walk out. That's been the experience. Have they fixed that yet?
I think overall what they fixed in terms of the product, it is more colors are in the product, being in stock on the right goods, and having the right fit. I think Vuori started as a men's brand. It's known as soft casual. They've added women's, and they're still in the growth phase.
Dana, it's good to see you.
Nice to see you too.
Thank you. Thank you for the update. Dana Towsey of Towsey Advisory Group on US retailers.
Okay. There was a whole discussion around Victoria's Secret where they were going to get rid of angels and do what women want, not necessarily the Victoria's Secret angels. And I believe that the angels have made a comeback. So it sort of has evolved.
It starts there.
It starts there. And I think that that's part of what's behind some of the shifts there.
It's become more aspirational again.
I mean, I guess so. Yeah, it's become more of a vision of lingerie.
Okay, interesting.
We did this really well. This is great.
Let's wait for next year and see what they have, because then Hillary will have made an impact.
Okay. Up next on the program, not that. Claudia Sam of New Century Advisors and Tom Sitsouris of Strategas from New York City. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Equity futures here positive across the board on the S&P, on the Nasdaq, on the Russell. The small caps outperforming once again, up by more than 0.25%. With 60 minutes until the cash open, let's get you an update on your morning movers. It's Manus Cranny. Morning, Manus.
Jonathan, a very good morning to you. So the headline on Stellantis is that Carlos Tavares, the efficiency czar, is to go. But it's the vault face that really grabs me, which is it goes from unanimous support for him to stay until 2026 to this to leave with immediate effect. This is essentially questioning the capacity of the efficiency czar to take the company forward and the direction they want to go in. Turin, we have a problem. That was the message from Michigan. He won't be missed here in the United States of America, where you've got Jeep, Ram, Chrysler, and Dodge. The U.S. dealer said it was reckless short-term decision-making that they opposed. Cities say you've got a dissipation of market share here in the United States of America. This is less about the problem with China. Just look at what they had. They had a market share of just under 12% in the second quarter of 2022. That is dissipated to just under 8%. This is not a China problem. This is a USA problem with sales. Roll it over and have a look at NVIDIA. It's a hard call here, down 0.25%. But what is the headwind, or what is the opportunity from the new set of regulation that the Biden administration has lobbied and leveled on top of the chip industry? 140 new companies will be restricted in terms of what they can sell. But Bridgewater sold 1.8 million shares at the end of the third quarter, and they lumped up and bought Supermicro. So a little bit of a back step for NVIDIA this Monday morning. You've just finished a conversation about retail, but it's worth pointing out that for Gap, you've got JP Morgan upgrading the stock to overweight from neutral. They put a price tag of $30 on this, so there's about 23% left in the upside. Why? They had a meeting with the CFO and the CEO. They believe the story. They believe in the reincarnation. They believe in the marketing story that has been delivered. The line is a consistent playbook of improved merchandising, marketing across all four brands. And just to let you know, I got the full 30% off, and I feel like I really did accomplish a bargain in Black Friday.
Good work, Manus Cranny. We're proud of you. Thank you, Manus. Thank you very much. Manus Cranny on some of the movers. Here's another one. Breaking news. Intel. The stock so far this year down by more than 50%. This headline will not be a surprise. Intel announcing the retirement of the CEO, Pat Gelsinger. The board has formed a search committee for his successor.
Yeah, this comes at a time where other chip manufacturers have done very well. And as you mentioned, the shares down 51% so far this year. He will also be stepping down from his position on the board. The foundry leadership is going to remain unchanged. Basically, the only thing that changes is that Pat Gelsinger will not be there. And you've made the point, John, that how do you feel as a leader when you step down and the shares go up? And that seems to be where things are, at least in the initial reading.
We say this all the time. You can learn something from the data and how the market responds to that data. The market's responding favorably to his exit. The stock is up by 3%. The hard work that's got to be done here, though, how offside this company is relative to where it needs to be for the market right now. Obviously, the winner at the moment is the likes of NVIDIA. What does this company need to do in the coming years, and I would say the coming decades, to improve things? This is a big turnaround effort.
Yeah, especially because their hands are somewhat tied due to the grants that they've gotten from the government in terms of how it's going to be deployed when they get that money. There are a lot of questions about how quickly you can turn around a ship in a fast-moving industry where there is a clear leader and they are gaining ground. Also, if Intel is going to be the national champion in the United States, how do they beef up their production in the U.S. when there isn't necessarily the expertise in a mass group of people who could actually make the products the same way that there is in, say, Taiwan?
We will, of course, have more updates for you through this morning. Just to go back over that breaking news from moments ago, Intel announcing the retirement of its CEO, Pat Gelsinger, the board conducting a search for a new CEO. Their stock is up in the pre-market by close to 5% now. Let's turn to the Federal Reserve. The next decision 2 weeks from Wednesday. After payrolls and CPI, Claudia Sahm of New Century Advisors weighing in on the Fed's future, writing for both the Fed and other policymakers, now is not the time for complacency. Watch the labor market and the rate of business formation. If they slip back and become less dynamic, then productivity and supply-driven growth could slip away too. The US economy has come too far in the last few years to allow that to happen. I'm pleased to say that Claudia Sahm is back with us now for more. Claudia, welcome to the program. I think we should start there, the supply side of the economy, and how much of the hard work that's been doing so far over the course of 2024, and where it leaves the Federal Reserve as it thinks about 2025 and beyond.
Right. Well, it is so important that we don't just look at a GDP number and say, oh, it's almost 3%. And move along. We need to stop and think, what is going on? Why is growth so good? Are we overheating? If we're overheating, then the Fed steps in, they raise rates, they cool things down. That is not what's happening. We have seen a real pickup in growth. Remember, we were promised a recession and we got an acceleration. And we've seen for 2 years running now almost 3% growth. And a lot of that, if you look under the hood, is coming from productivity. And that is the holy grail of economic prosperity. And we should be spending a lot of time trying to figure out exactly how did we get to this place that we've seen a pickup in growth. And this is something the US is seeing and our peer countries are not. So it's a really important question to dig into.
Claudia, given that people believe, and yourself as one of them, that this is becoming a productivity story, does this mean that from your perspective, it's not inflationary, that it doesn't necessarily preclude the Federal Reserve from cutting in a couple weeks' time?
Right. Inflation happens when demand is outstripping supply. That's the 101. There's more to it. But in general, if we have too much demand and not enough supply, then we're going to get price increases to kind of, make the market work. But if we can get more supply in there, and that is the lesson. We did not get the big disinflation without a recession, without this supply side help. And we got it not just from supply chains, we got it from workers coming online. And we also got this kick of getting people in more productive positions, getting more capital in their hands to do their jobs. And like that was such the way to solve the problem of the high inflation. Well, that's not the only problem that a good supply side solves. It also can really help us thinking about growth over the long term. But we got to get out of our head that it's like all growth and the Fed does interest rates. Like productivity is a really tough nut to crack. And it actually is not primarily about the Federal Reserve.
Claudia, how does Fed Chair Jay Powell message this at a time when he is going to be speaking on Wednesday at a moderated conversation ahead of a time where inevitably, as we've been hearing from a host of analysts, the Fed is likely to revise a lot of its projections with inflation going up, with unemployment going down, and with growth also going up, given the fact that you have seen those upside surprises to growth?
Powell has made a real effort on this, and I would just kind of tell him to, double down on it. He said multiple times the Fed doesn't have a growth mandate, but that's a kind of a wishy-washy way of saying that sometimes when growth is high, the Fed needs to step in, and sometimes when growth is high, the Fed needs to get out of the way. And this is one of those times where the Fed needs to get out of the way because there's productivity there and high interest rates being unnecessarily restrictive on the economy relative to the dual mandate. It has costs. This high growth is not guaranteed. Unfortunately, that is the thing about productivity that we have learned from the past is yeah, sometimes we get it, and holding on to it is what is really hard. So like, we should not be taking this lightly, that we've got this kind of growth pickup, this productivity renaissance. The question should be, what can all policymakers, and frankly, a lot of these levers are not with the Fed, they're with fiscal or other government authorities, but like, what levers can we pull to keep this going? And Powell continuing to go back to his dual mandate of the price stability and the labor market, the maximum employment, I think is important, because the more we've dug into and research with this productivity boom, it goes back to the labor market. The dynamic labor market is very much tied back to the dynamic economy, the higher productivity.
Well, let's talk about the labor force growth that we've seen, Claudia. And I wonder from your perspective whether you think it's distorted the Fed's understanding of the influence that they actually have over inflation.
I think the Fed has been very humble and open to the fact that there's a lot that's going on with inflation that we don't understand. And I think they have been probably clearer than a lot of the people watching the Fed that their tools have been they're limited, right? There's a lot of dynamics of inflation that have had to do with the supply side that are not primarily about the Fed. The Fed does have a mandate with inflation. They have stepped in. They do need to pay attention. And when we see inflation picking up, they would step back in. So it's not that the Fed is out of the picture with inflation. I think they have tried hard to make it a more nuanced conversation. Nuance is tough, right? But they can't give up on this. And I think this balancing the two sides of the mandate and just saying, hey, this is not about growth. High growth does not mean we need to hike. High growth does not mean that we have no reason to cut. It's our dual mandate. And the growth conversation is a separate piece of this. And if we have to look under the hood.
We enjoyed this conversation. It's good to see you. As always, Claudia Salmner of New Century Advisors. Claudia, thank you. Of course, Claudia mentioned we will hear from Chairman Powell later this week. We will get payrolls on Friday as well. So 2 events you need to look for. Next week, we'll get CPI. The week after that, a Federal Reserve decision. Mike McKee joins us around the table with more. Good morning, Mike.
Good morning. And we just got, while you guys were talking, 2 more speeches added to the Fed calendar this week. Tom Barkin of Richmond is going to be speaking on Wednesday and Thursday. So overall, we have a significant number of members of the Open Market Committee who are going to give us their thoughts. The only one that's really going to matter is Jay Powell, of course, as always. Where he is where the markets anticipate that the Fed will end up. And the real question is, what is he going to be able to say about where the Fed ends up, given that jobs isn't until Friday and CPI isn't until next week?
They all matter. I enjoy every single speech. I just want to say thank you for adding to
this
them.
Doesn't sound sincere.
I actually think it's fascinating. And I think it's fascinating that they're being added now. Because yes, it's before the quiet period, but also it's at a time where there's a real question about A, the Fed's independence, and B, how they're going to address some policy changes that are going to come down the pike that potentially could have a pretty significant impact on the economic outlook. How much is this trying to get ahead of that? To sort of come out there with terse answers to some of the questions, with Jay Powell saying, I will not go if I am asked.
Well, given the way they schedule, I don't think most of this is based on that. Some of it is an opportunity, shall we say, to talk about that. But when you look at what they've said about Fed independence, it's basically the same couple of sentences from every one of them, that it's important because it gives the Fed credibility, and you take that away and then the markets have a problem. They don't really go beyond that. And they don't want to talk about the who's going to be president. We shall not mention his name if we're on the Fed. The framework is now going to start being part of what they talk about. And Chris Waller's speaking today on that. There was an interesting Bill Dudley column you talked about earlier that said the Fed has some work to do there. And so we'll see how far these people want to go in sort of front running that. But the rest of it is going to be just kind of talking to their constituencies, especially the Fed bank presidents who are out talking to Rotary clubs and people like that, universities in their districts.
Tons of Fed speak coming up this week. Mike McKee on some of that Fed speak for you. Going into it, bond yields are higher across the curve, up now by close to 7 basis points on a 2-year. On a 10-year, up by 6. So just pushing higher after dropping through last week. With us around the table is Tom Tsouras of Strategas. Tom, good morning. It's good to see you.
Hey, good morning.
In the past, you've talked about this marriage between full employment and declining inflation. I think you said the honeymoon was going to come to an end. Has it come to an end already?
I think so. I think we're going to see inflation trickle a little bit lower from here. But I think for the most part in 2025, we're going to see it moving sideways. Let's say somewhere around 2.25% to 2.5%, both core and headline CPI, both converge around there. So a little bit lower. But I think that by the middle of next year, we're starting to see the second wave of inflation beginning to emerge.
Where is it coming from? Is it coming from policies or just naturally already existing inflation?
Well, history says, and we've looked at this data over 200 years of developed economies, about 85% of the time you get a second wave of inflation because the first wave is caused by something structurally changing, and it is amplified by fiscal and monetary policy. But the initial change is a structural shift in the economy. And I think the structural shift in the U.S. economy was the labor market became exceptionally rigid. COVID accelerated this. But the labor market became exceptionally rigid as we transitioned from the baby boomers retiring and leaving with the skills employers demanded to having the Gen Zs and millennials not necessarily having those skills just yet and being geographically rigid about where they wanted to work as well.
When you start talking about potential policies to come down the pike, how much is it really immigration and potential clampdowns on that could be more inflationary than, say, some of the tariffs?
Yeah, I think we've looked at this as well. In tariffs, what we found was, and we don't take credit for this work, but we're kind of quoting work that we've seen, but tariffs would add perhaps between 0 to 1% to CPI over the next 10 years. It's a pretty negligible amount. It could be worse if there's essentially retaliation tariffs, but it's not a huge impact. The deportation of labor has a much more substantial impact over 10 years, upwards of about 10% impact on CPI total. But the catch with that is there's a lot more uncertainty. And the reason for that is because you have to estimate what is the household formation rate of these households going to be, childbirths, their demand for housing, and what impact will that have on consumer goods and consumer prices. We don't know that answer yet.
Let's talk about immediate policy decisions. About 2 weeks away, Federal Reserve, are they hitting pause in December?
If they want to maintain this perception that they're independent, I say no. And let me speak to that. The Fed, in my opinion, has pigeonholed itself and has telegraphed too much easing for the next 12 months and an end to balance sheet reduction. If they pivot away from that, it's going to optically look politically motivated. I think they're stuck. Now, the data coming out Friday could make the case, if it comes in strong, that they don't have to go in December. But any sort of hawkish talk is going to look very suspicious.
What's the difference between being politically motivated and being policy motivated?
Well, I guess the way I'd say it is they made quite a bit of effort in the last 12 months to communicate, particularly an end to balance sheet reduction. Those types of efforts, for example, putting out a new piece of metric on their website talking about reserves in the system. This is their way of telegraphing that they desperately want to end balance sheet reduction. Even if the data changes, then they shouldn't have telegraphed that desire to end balance sheet reduction. 12 months ago, we were talking about Dallas Fed president speaking about the need to almost immediately end balance sheet reduction. They really kind of got ahead of themselves with that. So if they change course now, despite the fact that the data has improved since January, February, it's going to look suspicious. The market is going to see that as politically motivated.
So if they cut, how much do you not like the long end of the yield curve?
Well, for now, we actually like it because we see the next 3 to 4 months a liquidity bonanza coming in. We see upwards of 75 basis points of cuts coming between now and June. It's not a huge amount, and that's roughly what's priced in. We see a debt ceiling standoff taking place from December 31st, at least out to the middle of the first quarter, because despite the unified government, Republicans in the Senate are going to hold Donald Trump's feet to the fire on the budget for 2026 and going forward. So there's going to be a debt ceiling standoff. And we have this unintended consequence when we have a debt ceiling standoff where liquidity comes out of the Treasury's general account and goes into bank reserves. That actually flattens the Treasury curve. On top of that, the deficit should be substantially smaller next year. So for the first half of next year, we could actually be looking at a shortage of treasuries temporarily until we raise the debt ceiling. So we're actually bullish on duration until we get through that debt ceiling raise. When we get through that debt ceiling raise, it's off to the races again. Bond vigilantes are going to find that there's a new appetite to come in and put shorts on.
And then all bets are off. Tom, it's good to see you. Tom Sitouris of Strategas, his view on the next 12 months. Some breaking news for you in the last 15 minutes if you are just joining us. That breaking news comes from Intel. Intel is up in a pre-market by about 4%. On that news and some stories elsewhere, let's cross over to Danny Berger. Hey, Danny.
Hey, John. We begin with that breaking news. Shares up 4% for Intel. The company announcing the retirement of CEO Pat Gelsinger. After a 40-year career with the chip maker, Gelsinger also retired from the board of directors effective yesterday. The board has formed a search committee for a successor. Shares of Intel are down more than 50% so far this year. People familiar tell us that BlackRock is nearing a deal to buy private credit manager HBS Investment Partners. The agreement could be announced as early as this week, valuing HBS at more than $12 billion. The deal would give BlackRock, which manages $11.5 trillion, more than $50 billion of alternative assets. And it was a record-breaking weekend at the movies. AMC Theaters said more than 8.8 million went to the movies between Wednesday and Sunday. It was the company's biggest 5-day Thanksgiving period in its 104-year history. Disney was also a big winner. Moana 2 broke the record for highest-grossing Thanksgiving weekend with $221 million in ticket sales in the U.S. and Canada. And that's your brief. John.
Danny, thank you. We'll pick up on that Intel story in just a moment and catch up with Mandeep Singh of Bloomberg Intelligence on the other side of this commercial break, as well as setting you up for the week ahead as we count you down to Payrolls Friday from New York. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young Black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The open about 39 minutes away. Equities just about unchanged on the S&P 500. Your week ahead looks like this. Today we'll get ISM manufacturing plus S&P global manufacturing PMI. On Tuesday, JOLTS. Wednesday, remarks from Fed Chair Jay Powell plus ADP private payrolls and the Fed's beige book at 2 p.m. Eastern. On Thursday, the trade balance plus another round of jobless claims. On Friday, UMich sentiment and, of course, the big one, Payrolls Friday, the November payrolls report coming a little bit later this week. Got to get back to that breaking news. Intel announcing its CEO, Pat Gelsinger, is retiring effective immediately. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, the stock is higher by 4% on the session. It's lower by more than 50%. Big step back. the problems for this industry right now, the winners seem to be specializing in one thing. Either you design the chips or you make them. The people who are struggling, the Intels of this world, are trying to do everything. Why is that turning out to be so difficult?
I mean, Intel as an entity was too big to turn around to begin with. And we have a history of, tech turnarounds are far and few when you think about, Microsoft being the most successful turnaround. And the reason why they were so successful is because they anchored on one thing, cloud. I mean, they even gave up on the operating system. They didn't really invest on the operating system that much. In the case of Intel, the foundry turnaround was the hard part. I think the Achilles heel for Pat Gelsinger was he kept throwing money on foundry when TSMC was way ahead in terms of, that aggressive strategy around 5 nodes in 4 years. I mean, that was so unrealistic to begin with. So that's where focusing on the design side, I think, would have been the right approach. And we have a precedent, AMD being so successful because they spun off Global Foundries, the foundry side. And then look at how far they have come when it comes to the design side.
How much are Intel's hands tied for regardless of who comes in because of the government contracts, specifically tied to their presence as a foundry?
So I think the foundry side for Intel, look, they have been the recipient of the CHIPS Act. They have been getting money from the government in terms of turning that around. And in the case of Intel, they have an install base for x86, which is really the core architecture that's still being run on PCs. On the data center side, obviously, they have lost a lot of share to NVIDIA. But I think the government is in favor of local manufacturing, and that is supportive of Intel as a company, for sure.
I guess the larger question is, what should they be focusing on and what should they get rid of?
See, the problem is the foundry side is a very low margin business. Because it requires such heavy upfront CapEx, you're never going to get to that mid 70% gross margin like a TSMC for at least the next 5 to 7 years. On the design side, they do have a PC refresh cycle that's coming up. And if this AI wave is really secular, 10, 15 years, then people will upgrade PCs. And that's where Intel is still the dominant architecture. There is no NVIDIA. They are losing some share to AMD, but for the most part, it's still Intel. And that's where they can generate a ton of free cash flow. So I would say anybody stepping in now and coming in from outside or inside, I can't really guess, would be focusing more on that PC client-side opportunity.
So Mandeep, big changes, big challenges for them. What's the first thing they need to do?
Make a strategic decision. They actually tried to acquire Power Semis, which is another foundry company. That never went through because of regulatory hurdles. So clear on strategy. They have 3 rounds of layoffs. Nobody does that. If you're trying to turn around, you cut deep enough once. You don't try to do 3 rounds of layoffs. So I think setting that strategy would be paramount.
They're searching for a successor. Does it need to come outside of the company, given some of the things you've just said?
I mean, if it's from the design side, they should better get someone from NVIDIA, right? So, or if they're doubling down on foundry, then get somebody from TSMC. Those are the 2 clear leaders. So I think it makes sense to get somebody from one of those 2 companies.
Mandeep, it's good to see you. Appreciate it. Mandeep Singh there of Bloomberg Intelligence on the latest news from Intel. That stock is higher by a little more than 4%. No doubt Matt, Katie and Shanali will be picking up with this story in their A-blog in about 5 minutes' time, Bramo. That's the stock to watch into the opening bell.
You asked the question, does it have to come from outside the company? The new co-CEOs, at least temporarily, are David Zinsser and Michelle Holthaus. Zinsser was formerly the CEO of Micron, so it gives you some sort of sense of where the minds are at.
Coming up tomorrow on the programme, we'll continue the conversation with Ken Tropen of Graham Capital Management, Libby Cantrell of PIMCO, Tony Rodriguez of Nuveen, and David Rogel of BlackRock. From New York City, thank you for choosing Bloomberg TV. Welcome back to work for many of you. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
In 2000, post-Napster, generally everybody wrote off
the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers. You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Coming up, Pat Gelsinger retires instantly as Intel CEO after a storied career. Well, it was some story to the downside. The company he's leaving lost 50% of its value in the last 5 years. We'll have the latest on the new interim co-CEOs. Co-CEOs are always a great idea. Trouble under the hood. The Stellantis CEO also resigns unexpectedly as Volkswagen workers across Germany stage walkouts over the automaker's plan to cut costs. So a lot to talk about in the car space today. And most Black Friday shoppers bag their deals online. We'll ring up the latest trends as Cyber Monday comes on strong. First off, let's take a look at these markets. Fairly calm after a positive November. We had back-to-back monthly gains, and we're kicking off December with very little movement in terms of futures. On the S&P, we're up 3/100ths of 1%. NASDAQ futures up 0.2 of 1%. And the 10-year yield right now rising 5-6 basis points to 4.22, 4.23. Shonali, what are you looking at in terms of stocks?
A lot of calm over there. People still rolling back from their holiday weekends here. But of course, some companies rolling back strong. Gap being one of them, 4.6% higher pre-market. It's getting a boost after JP Morgan upgraded its rating on the apparel retailer. But then we're watching Stellantis falling more than 6.4%. Their CEO unexpectedly stepped down, stock taking a hit on that news. We'll talk more about it later in the show. Intel, as we've been talking about, jumping on the news that Pat Gelsinger is retiring as CEO, now up more than 4%, Matt.
All right, we're going to continue on that story right now. Joining us to talk more about it is Mandeep Singh of Bloomberg Intelligence. Mandeep, Pat Gelsinger retires effective immediately. The company has, no succession plan, so they put in 2 interim CEOs. Why?
Well, I mean, look, the turnaround clearly didn't play out the way he expected or the strategy that he laid out. And in this case, they're probably going to look for somebody externally to come in. Pat also came from outside, by the way. But clearly, he tried to take too much on in terms of turning around both the design side and the foundry side. And in this case, my bet would be anyone coming in is going to pick a side. Is Intel going to be a chip design company or a foundry company? I think turning around the ship as is with both the parts is very hard. That's what we've figured out.
How necessary was it to find a new CEO at this point in time? The fact that not only did they name interim CEOs, he's stepping down, as you said, imminently. Was it necessary to have new leadership in the middle of what's already a drastic turnaround story?
Well, so look at what has happened operationally with Intel. They've had a couple of rounds of layoffs, and the direction that Pat had laid out, not picking the side, as I said, has made it very hard for investors to gauge, is this company going to turn around even in the medium term? Because everyone anticipates a big PC upgrade cycle. Even though Intel is losing share on the data center side, the PC side, Intel is still dominating, and they are the incumbent player. So not participating in a PC refresh cycle would be a very big deal for a company like Intel. And I'm guessing the board didn't have enough confidence in Pat's strategy. So that's what it comes
Not
down
even
to.
enough confidence to leave him there for, say, a month while they find a new CEO to replace him full time. They had to have him out instantly and replace him with co-CEOs. What does this mean for the billions of dollars of government funding Intel is earmarked to get?
I mean, they'll still keep getting it because when you look at the precedent we have with AMD actually divested their foundry business into global foundries, and they became, a design company. I expect something similar to happen with Intel because the government wants chip manufacturing to stay in the U.S. So if the foundry business were to be divested, then they would continue to get funding because
as a designer?
As a manufacturer like TSMC.
So the foundries that they divest would continue to get the funding.
Yeah. And then on the chip design side, as I said, the PC business is still very healthy. It's going to generate its own free cash flow. So that may sustain on its own. So it comes down to whether foundry gets divested or not. And I think from a government perspective, they would continue to support that.
Mandeep, thank you so very much for that with us right now, of course, on this breaking news. It was only about a half an hour ago. Mandeep Singh of Bloomberg Intelligence. And joining us now on the broader markets, we're going to speak with Stuart Kaiser. He's head of U.S. equity trading strategy at Citigroup. And from what I understand, you're excited to shift gears here. There's payrolls on Friday. Market will quickly be shifting over to that. What are your expectations?
Yeah, I mean, the way the data is forecast to come out, it should be very positive for equities. I mean, consensus is about 200K on payrolls, still about a 2/3 chance that the Fed's going to cut on the 18th. So you put all that together, it does stack up pretty well for equities into year end. And I do think markets will take a little bit of a breather here from all the political headlines, hopefully just for a week or two.
We've already come so far so fast, right? I mean, we're up, 26% year to date on the S&P. Second year in a row with more than 20% gains. Do we advance significantly into year end? Does the January effect give us a significant boost, or what do you expect?
Yeah, I mean, I think our view is that you will rally into year end. Typically, early in the calendar year, you get kind of these rotations and things like that. So I think a lot of people are continuing to look at small cap as a little bit of a catch-up trade. You have very strong seasonality there. In addition, you have obviously kind of a Trump impulse going through the system as well. So yeah, we expect markets to rally into year end. We expect small cap to do well. I think as you look into 2025, it's hard obviously to envision another 25% year, 3 in a row. And I think the two reasons for that are probably valuation, A, does look a little extended, and then B, the earnings bogey for 2025 is relatively high for the S&P as well. So you are entering the year next year with a pretty high bar to begin with. So I think a lot of folks are looking at whether it's S&P equal weight, whether it's S&P small cap, Russell 2000 as potential catch-up trades early next year.
By the way, it does seem like we're only focused on the good parts of Trump 2.0 and not, I mean, like, we care about the tax cuts and deregulation. So we're rallying. And if someone mentions like mass deportations and tariffs, they say, that's just negotiation.
Yeah, I think that's right. Like, there's been three kind of primary election trades, I think. One is M&A targets. Those have been beneficiaries. The second is government spending. Those are more on the victim side. So I think that would be kind of the negative side of the Trump trade right now. And then you have this domestic versus foreign kind of imbalance going on. So domestic sales companies outperforming those international. So, I agree with you. I think, our view is election has three stages. You had the initial reaction, which was about sentiment. Now you're in kind of the policy proposal phase. Next year is going to be about implementation. And I think a lot of what you're talking about, those risks are really going to be activated once you actually start to see these policies get implemented. So we'll be eagerly awaiting that for 2025.
Stuart, hang on tight really quickly because I want to bring some more breaking news over. Supermicro is replacing its CFO, David Wygand. Remember, Supermicro has been under a lot of pressure, has short selling regulatory investigations here, and you are seeing the shares jump 11% pre-market, Matt. So I wanted to point that out as well because it's been a story that we've been watching. And of course, a lot of executive changes on this Monday morning.
Executive changes and massive volatility continues for this name, right? SMCI is the ticker. They lost their EY, I think, and then replaced them with another auditor. And that caused double-digit drops, then double-digit gains, and now we see another pre-market double-digit gain on another CEO shift. So interesting story, yeah.
Into the market. But Stuart, back to the broader markets, because there's another Trump trade. That's what we were talking about. And one was the Russell 2000. You had mentioned potential room for upside. It just had its best month since the end of 2023. I mean, it was up more than 11% last month. How much more does it really have to run?
I think people are girding up for a really positive seasonal. 30 out of the last 38 years, you've had Russell 2000 up in December by an average of about 2.5%. So I think you have a seasonal impulse. You have a deregulation/growth impulse from Trump. And then, as I alluded to, you also have kind of this M&A story out there. And I think all three of those are incrementally positive for Russell 2000. So I think at least into year end and potentially into early next year, as you get these kind of, rotations around calendar year end, we do think, Russell has some legs behind it.
It's amazing. More than 10% in 1 month for the Russell, right? The S&P for the month up 1%. So massive shift. And it makes me question, do we continue to see this rally in the S&P, or does this broadening out take some wind out of the sails of the mega cap stocks as, it drives other places in the market like small and mid caps?
Our view is to have that rotation working, you need S&P 500 higher. So S&P, I think returns are positive. Obviously, it is underperforming and should continue to underperform, consistent with how its kind of beta lines up. But our view is it's very hard to rotate into small cap, lower quality stocks at a time when markets are pulling back. So I actually think the rotation into small cap is almost conditional on the fact that you get S&P 500 higher.
So one thing you mentioned earlier is contingent on that Fed rate cut in December. Right now, market's pricing in a 62% chance. If you don't get it, what's the downside risk?
If you don't get it, I think that probably means you printed a really, really strong jobs report. So in that sense, I think equities are probably net still higher on that. Like, I'd much rather have a strong labor market with the Fed cuts being pushed out, which is frankly the thing we saw in the first half of this year anyway. So I think for the Fed to skip, that's telling you economic data is very, very strong. And I think equities can kind of rally through that. The Uber bull case is you get, call it 150 to 200K jobs. The Fed wants to get some cuts locked in ahead of potential risks like tariffs next year. And that should push equity markets higher. So if they skip, I think it's actually for good reasons in this case.
A lot of bullishness. Either way, walking into December, that is, of course, is Stuart Kaiser of Citigroup. We're now going to take a quick check on futures here as well, because equally bullish, not as bullish, though. You're watching the NASDAQ 100 futures up about 0.2%. Russell 2000 futures taking a little bit of a breather, roughly flat, and so is the S&P 500. But of course, that was after a strong November. We're going to get a look at some of the stocks moving ahead of the opening bell. Bring in Abigail Doolittle.
And beneath the surface, Shonali, we do certainly have some bigger movers than that relatively flat surface. Starting off with the shares of Tesla, this stock has been in a major rally move out of the April lows, a piece of that Trump trade. Today up nearly 2%. This says Roth MKM has upgraded shares to a buy. The analyst there saying that he believes that there's going to be a new pool of enthusiasts for Tesla vehicles. In addition, that the sunsetting credits, EV credits, could hurt the competitors. Additionally, Steve Stifel has raised their price target to a street high of $411. Turning to the shares of Block, this stock is also higher, right now up 3.4%. Bernstein is calling it a best new idea, saying that there's lots of catalysts for the stock. Separately, Goldman Sachs has raised their price target by about 10%, more than 10%, to $102 per share, suggesting there could be more upside potential. And then finally, rounding it out, the shares of Intel, today's big stock story. We do have them up about 3.9% off the highs on the news, of course, that CEO Pat Gelsinger is stepping down, retiring, the turnaround not gaining the steam that many had hoped. The stock on those failed turnaround hopes right now down more than 50%, although I will add, Matt, at the lows, it had been down closer to 60%. So off of the lows, but nonetheless, CEO Pat Gelsinger stepping down.
All right. Fascinating day for CEOs and CFOs. Abigail Doolittle, of course, the CFO of Super Microcomputer, also out, as well as the CEO of Stellantis. So a lot of shifts in the C-suite. Coming up, President Biden, speaking of shifts, taking his son Hunter off the hook. He promised he wouldn't do it. He wouldn't interfere in the U.S. judicial system. And then he does just that with a presidential pardon. That's next. This is Bloomberg.
Names in global leadership are on Bloomberg.
We need to do the green transition together. Let me simplify. Europe emits about 5% of all the world's CO2. The United States emits about 15%. China emits around 30%. So it's important that we find the technological and trade means to deal with this together between Europe and the United States. And China needs to pay too.
Nobody covers the top global leaders like Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot?
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Sorry.
My voice, my conversation, my poetry, you know.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed.